All
right, over to
screen.
you, Nicolas.
Okay. Hey, good evening, everyone, and thank you for participating in this webinar on crude oil organized by Phillip Futures. There is indeed a lot of things happening in the oil market. So I had to actually change my presentation this weekend and decided to focus exclusively on oil futures contracts because of a very important meeting planned for on Thursday between different producers. So my name is Nicolas. I'm a senior director for energy products at the CME Group. So before I start with this presentation, a couple of reminders for those who are not familiar with the CME Group. Our company owns and operates 4 exchanges for commodities and derivative instruments across all major asset classes. One of those exchanges is the NYMEX, the New York Mercantile Exchange, which is where basically we're listing all our energy contracts, most notably WTI, Crude Oil Futures, which is the most actively traded crude oil contracts in the world by volume, and the benchmark of North American oil and international price. So as part of our disclaimer, let me remind you that derivative instruments involve financial risk and are not suitable for all investors, and that nothing that I will present today and say today should be perceived as a trade recommendation or a forecast. So with this being said, let's have a look at crude oil prices, more precisely WTI futures. The following chart represents the daily closing price of WTI futures active contract for the past 20 years. As you can see, and you probably know, oil price have dropped significantly this year from above $60 per barrel early in January after the Iranian General Soleimani was killed by a US military attack, down to $20 per barrel at the end of March, before rebounding to nearly 26, 27, where we are now. So I will come back later in these presentations to the recent price movement, but first, it is worth putting it in perspective of the past events. As you can see from this graph, over the past 12 years, oil price have been through 2 shocks. The first one in 2008, during the financial crisis, when prices crashed from the all-time high around $145 per barrel to a low $35 per barrel, to rebound relatively quickly, thanks in part to a sharp and quick reduction of OPEC's production, mainly Saudi Arabia, and a strong demand by China. So 2008 was a demand shock. The second one in 2014 to 16 was a supply shock. What happened there is that Saudi Arabia and OPEC decided to stop adjusting their own production in an attempt to curb the increasing US shale oil production. It was basically a price war, a market share war, from which oil price has never really recovered. Before, oil was trading around $100 per barrel. We've never been back to those levels. What we're experiencing today, this year, is a combination of both a demand shock caused by the outbreak of the coronavirus and a demand shock as Russia and Saudi Arabia ignited a new price war. So for this reason, what is happening now is really no precedent. Let's first have a look at demand, and I will start with an important figure. The global oil demand reached 100 million barrels per day last year. Okay, 100 million barrels per day, which makes it very convenient to quickly convert barrels to percentage, as an adjustment of 1 million barrel per day corresponds to 1%. So during this presentation, I will mention figures in barrel, either 1,000 barrel or million barrel per day. So it's good to have in mind this very simple rule of thumb, plus or minus 1 million barrel per day equal plus or minus 1% of the oil physical market. I just mentioned that the current situation has no precedent, and that is particularly true on the demand side. COVID-19 is currently destroying oil demand to an extent that still needs to be fully quantified, but clearly exceeds what we have seen in previous shock. Some firms and analysts are now talking about short-term destruction of up to 25 to 30 million barrels per day of oil demand. So around a third of the oil demand has been crashed currently. So why is COVID-19 impacting so much oil demand? Well, first, it's because most, if not all, of the major consumers are impacted by the virus outbreak. A group of 17 countries represent 70% of the oil demand. And as you can see from these lists, most of them have been severely impacted by the virus. Started obviously with China, which represent 13% of the total oil demand, and later Europe, and now the US. The second reason is that the measures taken by these countries to limit population movements are directly impacting demand for oil products. As an illustration, I highlighted here the composition of the US oil demand by product. As you can see, nearly half of it, or 9 million barrels per day, is gasoline, which means the fuel used by everybody to drive to work, shopping, visiting friends. So this is obviously directly impacted right now. Now, the world is experiencing a massive destruction of oil demand because transportation fuel are particularly impacted. Transportation fuel, gasoline, diesel, but as well kerosene for planes, bunker for ships. And they represent around 2/3 of the oil world demand. Just looking at the situation in the US, gasoline demand have dropped from an average 9.2 million barrels per day to just 6.7 million barrels per day last week. And as you can see from this chart, that was really a brutal decline. That alone is 2.5% of the global oil demand. So this is important to keep this in mind because that makes the links between demand destruction and oil. As demand for gasoline drops massively, so does gasoline price, which has traded below crude oil prices, meaning that refiners have currently no incentive to purchase and process oil as their margin has shrunk and in some cases turned negative. Another notable point is that unlike previous shocks, low prices cannot boost demand currently as consumers are locked down. So even if gas price at the pump in the US is low, a few people can actually benefit from those low prices. So once again, we are in a very different situation. A quick word on air traffic. It's not only gasoline and diesel that are impacted. Travel restrictions are closing down international aviations. According to the International Aviation Transport Association, IATA, booking dropped by nearly 60% for Europe in March and nearly 50% in the US for the same month of March. Okay, so we're talking about booking. So we don't have yet the numbers for April, but we can imagine that the impact is even bigger now in the US. So this led to the numbers of flights in the world to drop from an average of 170,000 flights per day to just 80,000 flights per day, which is down by 50%. So the air transportation industry represents around 8% of the global oil demand. So again, these figures suggest massive reduction in oil demand with, in this case, a midterm impact that could be longer than the one of gasoline, depending on how long travel restrictions will be enforced. So I'm going to conclude on oil demand destructions with a few reports that are anticipated, read, and commented by institutional traders. First, you have the EIA short-term energy outlook. The EIA is a US Energy Information Agency, so it's a federal agency. Their next report will be actually published tonight. And as usual, we'll provide with the latest available data for oil supply, demand, inventory, as well as forecasts for demand and prices. So forecasts are particularly important for traders of futures contracts. The other two that I mentioned here will be published the following week. Again, let me be clear. I do not suggest everyone to read these reports, which are over 100 pages long, unless you want to prepare a PhD on oil. But it is important to know when they will be released, because the market is expecting those data, especially right now where people want to know exactly what's happening. Now, before I switch to the supply side, we like to provide a quick overview of the WTI futures, product that I've already mentioned on several occasions during this presentation. So WTI futures contract is listed on NYMEX, a part of the CME Group. And as I mentioned, is the most actively traded oil futures in the world. WTI stands for Western Texas Intermediates. So it's a type of oil produced in the US. Our contract is denominated for 1,000 barrels, so one lot equal 1,000 barrel, with a quotation in US dollar per barrel and a price increment of 1 cent per barrel. So which means one tick, one price increment for one contract is equal to $10. It's traded electronically with a strong liquidity throughout the day. The table on the right is just an example of the trading activity. The listing rule is one contract per calendar month up to 10 calendar years. Trading activities split along these maturities, with the first contract being the most actively traded. So traders can access WTI futures for their trading activity through brokers like Phillips Futures. So by the way, to avoid any confusion, this table is an illustration and show prices and market activity 2 years ago. Nothing's compared to the current market activity. In particular, the market is now in a sharp contango and not in backwardation. So let's now have a look at the recent market activity, starting with prices, and then I will touch a word on the volatility. So the upper charts represents WTI price this year. For these two charts, I use candlesticks. You are most probably familiar with such representation, but if not the case, the body of the candle represent the opening and the closing price. Colored candles mean falling prices, so a closing price below opening, and the line going out of the body of the candle represent the high and the low of the day. So it's a very convenient way to represent daily activity with just one chart. So the oil market has been extremely volatile recently, with the lowest closing price, which been around $20. Really, $20 has been a strong floor on oil prices on WTI. So the lowest close was around 68% down from the high of this year. So that's a massive move. We have seen several days with over 20% price movement within a day, including on the Monday following the March OPEC meeting. So I will come back to that, where basically the market opened much lower than the previous close and then keep dropping. Okay, and what we've seen recently here is end of last week, as US President Trump tweeted about a potential agreement with Saudi Arabia and Russia to cut something about 10 to 15 million barrels of oil of production, and news of the coming OPEC meeting on Thursday. Then the market move up nearly 30%. This chart is only updated up to Friday. Yesterday, the market traded a little bit down. We are now around 26, 27. So I will touch later on this OPEC meeting. I will come that in a moment when I talk about the supply side. But as you can see, OPEC decisions have moved the market significantly in recent time, and this is important to keep this in mind as we have this very important meeting coming on Thursday. But let me stress first the current volatility of the market. It can be seen on the two charts which are at the bottom of this slide. those charts basically represent the volatility in two ways. The one on the left represents basically the change in value for one lot from one closing price to the other. Okay, again, one lot is 1,000 barrels, so if the price moved by $1, that makes the $1,000 move from one close to another. As we've seen since this OPEC meeting in March, where basically they couldn't reach any agreement on production cuts, we have seen a lot of volatility. Then, of course, COVID-19 plays a role as well. So, long story short, a very volatile market. Another way to look at it is the intraday value change, which is here represented. That's the difference between the high of the day and the low of the day. Again, multiplied by the size of the contract. So you see at the beginning of the year, we had moved for one contract of WTI, a move of between roughly $1,000 to $2,000 per day, but now we have seen days above $8,000. So a huge volatility, but what is particularly relevant and is an acknowledgement of the resilience of our market. Despite this huge volatility and increasing trading volumes, NYMEX WTI Futures has maintained a very tight bid-ask spread, so a difference between the price at which you can buy and the price you can sell. In the more extreme cases, the bid-ask spread has remained below 2 ticks, okay, during Asian hours or US hours, okay, and that's really a great achievement, and that's come from the fact that we are seeing significant trading activity throughout the day. The chart on the upper part of this slide shows what we call the average daily volumes for the month of March, split by hours in Singapore time, okay? And as you can see from our early morning, we have seen trading volumes of about 20,000 contract per hour, so that's already massive. Then quickly ramping up above 50,000 contract per hours during our afternoon, and obviously peaking during US hours for the market close. What this shows is that there is enough liquidity, enough depth of the trading book to allow every trader, every buyer, every seller to execute its trade in an efficient manner, despite this very strong volatility. So I finished on that point. If you want to learn more about the liquidity of WTI futures and other CME Group contracts, we have a nice liquidity tool on our website. Everyone can analyze bid-ask spread using this tool, that we provide for free on our website. Okay, so now time to look at the supply shock, which again is relevant this week. We have the OPEC Plus meeting, hopefully coming on Thursday. So I mentioned previously the 2014 and 16 period as the previous supply shock. The comparison with this previous episode is interesting because it helps understand the recent decision of OPEC and Russia in March relative to their oil production. So to make it short, back in 2014, after years of balancing the market in the context of rising US production, Saudi Arabia say, okay, that's enough. And that has triggered a massive drop of oil prices. The market has remained oversupply for 2 years, and at the end of 2016, not only OPEC decided to implement quotas, but it was joined by other producing countries, in particular Russia, to form what we now call the OPEC Plus. OPEC Plus not being the official name, is just a common way of describing OPEC plus the other producers that join them in their concerted efforts to curb the productions. So early March this year, the market was expecting, or what the market was expecting was to know whether this group, the OPEC Plus, will cut more barrel to face the drop in demand, or if they will just like renew their current quotas. Instead, they couldn't reach any agreements, and even completely the opposite. Russia declared that quota were not biting anymore starting April 1st, so starting last week. And Saudi Arabia, the very next day, announced that it will ramp up its productions to full capacity. So that's why the market have been dropping so much since beginning of March. So I will let aside the fight for market share between Russia and Saudi Arabia. Um, let's be clear, the decisions to flood the market right now with additional barrels is clearly targeting non-OPEC producers and in particular the US shale oil producers. The US became the largest oil producer in 2018 thanks to massive growth of the non-conventional oil. So this chart represents on the left scale the total US oil production, which is as well represented by the dark blue line. Total US crude oil production reached 13 million barrels per day recently. On this graph, you can see as well some key region for shale oil. Each region is represented by a color, and the production can be read on the right. So if you look more specifically at the period 2014 and 16, so the last attempt of Saudi Arabia to curb US production, as I just mentioned, so market were oversupplied, and price were relatively lower, with a low at $35. So not as low as we have now, but significantly lower that the market was used to. Well, if you look at this period, 2014 to 16, the US production indeed flattened and even decreased, but probably not to the extent that OPEC had expected. Shale oil producers have proved to be more resilient than expected for a variety of reasons. First of all, cost cutting and allocation of resources to the lowest cost producing region. If you look at the chart, some region, in particular the one in purple called Eagle Ford, declined during those years, but the one in brown called Permian was increasing and have still then been really the engine of US production growth. Now, Permian is particularly interesting for us because it's located in Western Texas. So if you remember, WTI stands for West Texas Intermediate. Permian oil corresponds to WTI quality, and the Permian region is linked by pipeline to Cushing in Oklahoma, which is the delivery location of a NYMEX WTI Futures. Another reason for the resilience of US producer is that part of their production was hedged, and therefore the drop of price was mitigated. So this, the hedging part, is still the case this year. So producers in the US tends to hedge most of their production. Whereas the question is whether there is still a lot of room for cost cutting. One of my friends in the industry told me last week, last time we cut into the fat, we might have to cut into muscle this time. So the plan to curb US production only worked partially last time, a few years back, but Russia and Saudi, in a sense of deja vu, are betting on the same strategy again, but with a massive difference. That's probably even they have underestimated, and which is the impact of COVID-19 on demand. The market can't just not be oversupplied by 25 million barrels per day for very long. Storages, tanks, cargoes are quickly getting full, and therefore there is a risk to see a price going lower and stay lower for longer. So this week, again, we have on Thursday, hopefully, if it's not delayed or postponed, an important meeting from OPEC with most probably Russia and many other producers. This is an emergency meeting that wasn't planned, was called by many distressed OPEC members like Iraq, and seemed to have been brokered with a little help from US President Donald Trump. So let's talk a little bit about OPEC. And my key message will be, looking at OPEC production might be very confusing and is probably not the best indicator, okay? first of all, depending on sources, numbers are different, but more importantly, announced production cuts and actual production don't match. Okay, if you look at this chart representing OPEC monthly production over the past few years, it peaked in mid 2016 at about 34 million barrels per day and moved down below 20 million barrels per day in January this year. So which means 6 million barrels lower than the previous peak, okay? Whereas actually the OPEC agreed production cut was only less than 2 million. So due to the counts, it doesn't work, okay? I will come to the second point in a moment, but first, what can we expect from this very important meeting and what will be discussed? In his tweet last week, President Trump mentioned about a cut of 10 to 15 million barrels per day, which obviously, as we've seen, have moved the markets up. 10 to 15 million barrels per day will indeed be a great support to the oil industry to counter a decrease of demand, which is, as we mentioned earlier, probably around 25 million barrels per day or even more. Anything shorter than that will probably be perceived negatively by the markets. Okay. The problem is that 15 million or even 10 millions is a massive cut. Keep in mind again that the last agreements of OPEC Plus, so Saudi Arabia, Russia, and all the others, was only 2.1 million, not 10, not 15, 2.1. Okay, and that was the biggest cut ever agreed. So it will need a big commitment from every OPEC member, Russia, and other producers to get to this level of 10 to 15 million barrels. So to finish on OPEC and why counting barrel based on quota doesn't work, it's important to keep in mind that OPEC's production is not only about agreed cuts. For several OPEC members, production depends as well on outages and international sanctions. And something that people as well tends to forget, leaving OPEC is actually not as complicated as Brexit. And OPEC members have changed in recent times. So just mention a few of those examples. For US sanctions, we have currently 2 members under US sanction. Venezuela production has been spiraling down and is now below 1 million barrels per day. And Iran production is currently down by 1.5 million barrels per day since the US re-implemented strict sanction on Iranian exports. Libya production is now down to virtually zero as the civil war intensified earlier this year. And when it comes to member, during the previous meeting in March that I already mentioned, Ecuador confirmed that it was leaving the cartel. Ecuador produced 500,000 barrels. So automatically in the next report of OPEC, OPEC production will be down by 500,000 barrels just because Ecuador left. So honestly, it's very complicated to follow. I don't think it's necessarily the best indicator of the market. Okay, so again, I want to highlight this meeting on Thursday. This is a big thing. And so let's talk about producers in general. To curb production in line with demand, there are basically 2 ways of doing. Either you let the market sort it out by itself, which means production will have to adapt to price, and producers with the highest cost should be, in theory, the first one to shut down wells. Okay, that's the theory, and that's let the market sort it by itself. The other way is basically producers decide of a voluntary mechanism like production cut or quotas. But in this case, no one's want to do it alone. Okay, no one wants to take the burden on his own. So this chart shows the main producers with their respective production for the months of January 2020. On the left, you have the OPEC countries, followed by the main producer by geographic regions. In dark blue are the one who participate the previous cut, so basically the OPEC plus members. So you will find Russia, Oman, Mexico. Okay, and the one in light blue are the one who didn't participate these deals, either because they favor market forces like US, Canada, and Norway, or because their law, national law, doesn't allow any participation into such cartel. That's the case for Brazil. But here as well, all the cards are a bit messed up because we are in an exceptional time. 25 million barrels per day or even more of demand destruction is never been seen before. So on one hand, we all agree, I mean, everyone agrees that a cut of 10 or 15 million barrels per day is possible, but seems difficult to adopt for OPEC Plus without the participation of other producers, most notably the world largest, the US. On the other hand, we have countries like Norway and Canada who have made sign that they were ready at least to participate in the discussion. So the outcome in this meeting in 3 days, if it takes place, remain very uncertain, but definitely will focus the attention of the markets. In the case of an agreement, the implementation of such deal, meaning controlling that every participant stick to his quota month after month, will be followed very closely by the market. So really, really an important time for the market. Obviously, I have no idea what's going to happen. If I knew, I will probably be a famous in 3 days, but I have to be honest, I have no clue. Every scenarios are on the table. Now, as much as this coming meeting is important, so this meeting is discussions between nations, basically. You have as well other actions which are being taken by private firms, by producers, okay? Some private producers, if not all of them, have already announced cuts in their expenses, in CapEx. Some of them in production. We're seeing as well the number of rig inactivity in the US. So rig is basically the equipment to drill wells. Okay, so we have seen the numbers of rig inactivity in the US plummeting, and as I just mentioned, firms have slashed their budget for this year. So here on these charts, this is a selection of few producers, few firms, including majors, national oil company, what we call the NOC, and mid-cap producer from different regions. So all the majors, it's interesting, have announced a cut by around 20%, while some of the mid-cap producers like Oxy, so it's a US producer with a strong position in the shale oil, slashed its capex by 50%. Canada National Resources around 30% of its capex, similar to EOG Resources in the US, another important shale oil players. But what is interesting as well is that NOCs are not immune. While the kind of Shell and BP cut their capex by 20%, Saudi Aramco cut its capex by 30%. That's very important to keep in mind the different dynamics behind these cuts, whether it's cut in capex or cut in production. Shale oil producers or oil sand producers in Canada are private firms looking to maximize their profits. If oil price fall below their production cost, ultimately at some point they will shut wells. Okay, so they look at what we call their production cost, or more often what we call their break-even price. So the price of oil at which they don't make revenue anymore. Okay, but NOCs, which might have a lower break-even price in some cases, suggesting that they are in a better position. Actually, their government relies a lot on revenues generated by oil productions to balance their national budgets and service the national debt. So the question for the national oil company in this case is not whether producing oil is still profitable, but rather if their business provides enough cash to their country. So as we can see from the cut of capex from Saudi Aramco, the oil price war hurt fiscal revenues of the oil producers in the Middle East, including Saudis. And interestingly enough, credit rating agencies have warned recently that a new wave of sovereign rating downgrades could be in the work if oil slumps continue. So that as well is putting pressure on producers, and my message here is that everyone feels the pressure. So I finish this presentation. I want to mention inventories because we have seen that the oil market and therefore WTI prices have been under pressure as supply exceed demand. Now, this oil which is produced and not consumed need to find a place, and is currently being pumped into storages, tankers, train, wherever possible around the world. Inventories are a very good indicator of imbalances between supply and demand. It's actually the fastest way to assess the situation of the markets. And with the massive current oversupply, watching inventories become ever more relevant. I highlight here as an example inventories at Cushing, which again is the delivery place of NYMEX WTI Future and the largest and more important hub for oil in the US with around 70 million barrels of capacity. This graph shows the weekly inventories published by the EIA every Wednesday. The gray area representing the range of the past 5 years, whereas the light blue line as being the 5 years average. What you see 2020, it's not a surprise. It has started to increase. It is worth noting that we have only a few weekly data since the US went into a partial lockdown. So the market is expected an increase in the data tomorrow, Wednesday night. So I just mentioned the EIA weekly report. This is really one of the key data that every institutional trader will watch carefully every week, independently from the current situation. And trading volumes and volatility might increase after the release of those data if the numbers differ from the market expectation. Those data are released, I mentioned, every week on the Wednesday during our nights at 10:30. It's always very active moments of the market. There is another set of data published the day before the API data. Those ones are unfortunately not in the public domain, but the EIA data are with historical that you can download in Excel spreadsheets. It's very detailed. They mention not only inventories at Cushing, but as well per region, what they call in the US the PAD 1 to 5, as well as import refinery run. So really an important document for traders, and I wanted to bring that to your attention. Not necessarily for you to go and check, but more for your awareness if you decided to trade NYMEX WTI futures. So a couple of key events this week. Tomorrow we have the EIA short-term energy outlook with forecast on demand and price. We have as well, it's tonight. Tomorrow we have the EIA reports, and Thursday we have these potentially in very big meetings with OPEC, Russia, and who knows, maybe Canada, Norway, or the US. I haven't mentioned what is the position of the US because it's a bit difficult to follow. After President Trump tweeted about this agreement with Saudi and Russia, he has actually shown very few willingness for the US producer to participate in the discussion. So it seems that he expects other people to cut production. He has even talked about implementing tariff on Saudi's oil and Russian oil. So the US position as we talk right now is not really clear. And with that, I go to a short summary. So WTI bottomed at $20 per barrel this year. and as of April 6th was trading around $26 per barrel. What we've observed in terms of trading activity on our exchanges, a very resilient market, obviously a strong liquidity, obviously a great volatility, but what is important is a bid-ask spread which are stayed below 2 ticks thanks to a very strong depth of the book. The current demand destruction is estimated by analysts around 25% of the global physical oil market, with some data to be released tonight. OPEC meeting on Thursday will probably be challenging, and the outcome might depend on which nation will join the discussion. Some producers have already taken initial steps to curb production. Decision to shut wells depend on break-even prices as well as national budget or debt constraints. And last but not least, storage around the world are quickly getting filled, and inventories will be closely watched by every market participant in the coming days. And with that, I think I'm just in time. So I'm done with this presentation and we can open the Q&A if there is any question. Thank you very much.
All right, Nicolas, we have a few questions on the line. First one is something everybody wants to know. Has crude oil bottomed out yet?
Well, I don't have an answer for that. If I look at the historical data again, because you have to understand as an exchange, we are regulated, so we don't make forecasts. We're not allowed to do that, but I can talk about what we've observed in the past. The lowest price was below 10, and that was not this century, but the previous one, somewhere around the mid 80s, mid 90s, where oil price was low. So technically speaking, oil can go lower than that, in particular if we keep in the market oversupplied. As I mentioned, the previous supply shock or demand shock, we were talking about an oversupply between 1.5 to 2 million barrels per day. Here, no one really knows how long COVID-19 will last, but the current impact is more around 25 million barrels per day. So that's putting a lot of pressure. So can it go lower? It has already been lower back a few decades ago. Right now, we're really depending on what producers are going to do, either, as I mentioned, by concerted decision to cut production or just being forced to cut because at those level of prices, not everyone is making money in the industry.
All right, before we go on to the next few questions, can I just request if you have burning questions that you want Nicolas to address, please type them into the question box. All right, for those of you who would like a copy of this webinar and the slides, rest assured we will share a link to the webinar. It is recorded, so we'll share a link in our follow-up email. All right, so on to the next question. Let me see. All right, Nicolas, what would you expect for the coming Thursday OPEC meeting? What do you think is going to happen?
Well, the first thing I really expect is this market to take place. I didn't mention, but so it was announced on Friday by Saudi Aramco. They were calling from this emergency meeting, and it was supposed to be taking place on Monday, and it was postponed to Thursday. So first, hopefully, it's going to happen on Thursday. The quicker, the better for everyone. People, again, it's not like people are going to start the discussions on Thursday. The discussions are taking place already. So diplomats and producers are discussing. As I mentioned, everything is possible. It seems that no one really had expected such a sharp drop in oil demand. So which means that even firms like Saudi Aramco, which has ramped up their productions from somewhere 9.7 to 12 million barrels currently, have an incentive to go to an agreement. But again, this agreement has to be a consensus from everyone. What I'm quite sure that there's going to be volatility around the event, and that's my key message. And as I mentioned, President Trump announced some numbers around 10 to 15 million barrels per day. That has no value if the US doesn't participate the event, but those numbers have been given. So now that's become pretty much a benchmark that is expected by the market. So we will see what's going to happen. Really on that one, it's very difficult to know who's going to attend, if the market is, if the meeting is going to take place, and what's going to come out of this discussion. And the last thing I wanted to remind as well on that, the meeting is taking place on Thursday. Friday is Good Friday. Exchanges are closed, so which means that we will have a 3 days break, Friday, Saturday, and Sunday before the markets reopen. So again, this is an environment where you could see a bumpy market.
All right, thank you for the reminder, Nicholas. Yes, that's 3 days break before you can place your trade. The next question is how likely, since it's how likely is U.S. to join OPEC Plus to cut production?
Well, there's it's difficult to follow U.S. politics. Everyone has tried to do this under this administration's come to the same conclusion. President Trump was the one pushing for the meeting, but after some discussion this weekend with producers in Texas, it seemed that there is no clear consensus among U.S. producers to participate. Look, there is here a debate which goes beyond the current situation, which is what is the best way to address such situation. The U.S. market, just like Norway, has always been in the position that the forces of the market are the best way to solve those kind of issues. Okay, so let's price do what they have to do, and producer will have to cut their production or ramp up. So if they were to join the discussion, that would be really something new. Norway, that I just mentioned, which has a relatively similar position, already joined some cuts in 2002 after the 9/11 attack. So probably Norway could be on the table. The US, it doesn't seem as of today that they will be joining the discussion, which again makes it harder to reach 15 million barrel per day.
All right, so Nicholas, will we see oil price slowly move its way up after COVID-19? The situation is clearer.
Yeah, well, that's the other reason why producers, in particular Russia and Saudi Arabia, might have a strong incentive to cut. The longer the oversupply lasts, the more difficult it will be for price to rebound. Okay, because you will have plenty of inventories, and so the initial position of Russia in March, or at least from what people think, what was their position, they thought early March, when they didn't want to agree on any cut, they thought that COVID-19 would be short-lived, and so the impact on the market will be gone in a matter of weeks. And so they thought that there was no need for a cut. Now it's clear now that it's not going to disappear within few weeks. And in the meantime, if producers keep pumping at full speed, then it's going to be hard for the oil price to rebound. So again, if OPEC reach an agreement, OPEC plus reach an agreement of, let's say, 10 million barrels per day, it's not going to balance the market today, but it will help the market in the coming months to get back on its feet. And the higher the agreed cuts, the faster we can expect the markets to rebound.
All right, we have an interesting question from James. James is asking, are we expecting some sanctions to be reduced for Iran?
Well, it doesn't seem to be the case from the US. Right now, not with this administration, and I will go even further, but even on the Iranian side, I mean, President Rouhani, who really was elected on plenty of reasons in Iran, but one of them, his political agenda was to negotiate a deal with Western powers, a nuclear deal on Western powers to get out of the sanctions. The deal was negotiated, but once President Trump was elected, the US pulled out of this deal and Iran are back into sanction. That has put the leaders in Iran, we were on the side of let's negotiate in a very difficult position internally. And then later on, in January this year, you had the killing of General Soleimani, who really put the hardliner in Iran back into the driving seat. There has been some election in the Iranian parliament recently, and it's not the moderate who won the majority. So now the question is really not only within the US, but I don't think that Iran's want to get back on the negotiation table. This being said, again, we are living very different times now. Everything can change in the next weeks or months.
All right. So Nicholas has shared that for oil price historically has dropped single digit sometime in the last century. And for oil prices to go back to 50, what would we see? What would have to happen in the near term?
Well, usually, when oil price move up, it's usually because there's something bad happening somewhere in the world. So, I mean, we can see like if the world go back to normal. I mean, we're gonna get through this virus. There is no doubt. The question is when, but we're going to get down with it. Then, as I said, the price might rebound. That will depend really of how much the market has been oversupplied and for how long. Back to $50 might take some time. I have no idea, but again, usually there is always something happening in the oil market which is unexpected, and that's usually the wild card which are moving oil. I haven't talked about geopolitics in this presentation, which was a very hot topic up to last year. Again, I'm not calling for any bad news or wishing any disaster, but that would be probably a wild card to keep in mind. As I said, some countries are really under pressure. You take a countries like Iraq, just to name one, 98% of its national budget incomes come from oil revenues. There's a lot of pressure on plenty of countries. You don't know what can happen. It's not necessarily the current situation that can move the oil price back to where they were a couple of months ago. So yeah, it's always expect the unexpected in the oil markets.
I must say we've had we have so many questions coming in, and it's making it very hard for me to pick the last question today. All right, so this sounds really interesting from Frankie. Frankie's question is, what is the minimum cost of drilling for the respective countries like US, Russia, and Saudi Arabia? Would you be able to share some insights?
Well, that's again is a good question. There's different estimation on that. I mean, the Saudis are always say that they could drill some of their wells at below $10 per barrel. But again, for them, the economics is more like they need money from the oil industry to finance their everything, including their war in Yemen and other things. So, but Saudi Arabia is probably among the lowest producing costs. Um, Among the highest, definitely you have Canada, the Canadian oil sand, and Canada produce 5 million barrels per day, so it's not a small producer. And when it comes to shale oil producers, the numbers really change from the mid 30s to the mid $50 per barrel, depending on the firms, depending on the plays. So it's hard to really give a number. It's definitely higher than Saudi Aramco, for instance, and lower than Canadian oil sands. But again, something that you need to keep in mind is that a lot of those mid-cap producers in the US, shale oil producers, have to hedge at least sometimes up to 50 to 60% of their production just by the way they finance their drilling activity. It's what we call reserve-based finance. So banks are basically giving them loans, but based on their proven reserve, and ask those firms to hedge to make sure they can service the debt. So they might have a higher break-even point or producing cost than Saudi Arabia, but they are partially immune because of their hedging strategy. So I don't have the numbers, exact numbers, to be honest. And I think, again, it's just like looking at OPEC production. It might not be really the best indicator. Really, I mentioned a lot about inventories because I think it's the fastest way to follow the markets right now.
All right. Thank you so much, Nicholas. And thank you for being a wonderful audience today. So many questions coming in. And since there's quite a bit of interest in crude oil, maybe, I'll put in a request to Nicholas to come back again sometime in a few weeks after developments in the market are clearer to us. Nicholas, what say you? Maybe we can do this some other time in the near future.
Yeah, sure. Pleasure. Thank you very much.
All right, great. Thank you so much, Nicholas. Thank you for being a wonderful audience. Look out for our next webinar. We'll send you the details in our follow-up email. Once again, this webinar is recorded, so rest assured we will share the link with you in our follow-up email tomorrow. All right, meanwhile, have a good night. Stay safe, and I'll speak to you soon. Bye-bye.